Welcome back, Mobile Home Park Nation. Ferd here again today with another episode of the Mobile Home Park Lawyer Podcast. My guest today, he's a friend of mine. We sat on the same board together for Kansas City CCIM chapter. He knows all kinds of stuff about real estate. He's a mortgage loan originator. He works at Grandbridge Real Estate Capital. Please help me welcome Frank Sciara. Frank, welcome to the show.
Thanks, Ferd. Appreciate it. Happy to be here and talk about mobile home park financing with you today.
Yeah,
how you been?
I'm doing well, man. Staying dry, rainy day here in Kansas City, as you know. But
Yep.
Well, Frank, I know a lot about you. For some of our audience that may not, tell us a little more about your background and what you do now. Obviously, also, I know something that you bring to the table that a lot of other lenders don't is you're kind of interdisciplinary in a sense that you work on more than just mobile home parks. You do multifamily, other stuff. So give our audience a little bit more about your background. We can then jump into some specifics.
Sure, happy to. So I'm with Grandbridge Real Estate Capital. I've been with them for 16 years now. High level, we're one of the largest commercial mortgage banking firms in the country, specialize in providing long-term fixed rate, non-recourse financing for all multifamily and commercial property types. So I'm a generalist to work on a lot of different property types, including mobile home parks. Work with multiple capital sources as well, including Fannie Mae, Freddie Mac, HUD, work with probably 50 different life insurance companies. We work with Wall Street firms to help that securitize loans. So probably 100 different capital sources all in. So have a lot of different buckets of money, so to speak, that we can help place loans depending on the situation and the property and maybe what somebody's trying to do with it.
Got it. And I know from talking to the past, typically you're at, I say medium to larger loans. You're not going to deal with the $300,000 loan. You're dealing minimum $1 million, but oftentimes you're in the $5, $10, $20 million range.
That's right. Our minimum loan is typically $1 million. Our sweet spot's probably in that, I'd call it, 5 to 20. But there's really no maximum. We work with some capital sources. We've taken down some really large portfolios over the years that'll be, 100+ million. So again, with the number of capital sources we work with, we can cover different loan sizes.
No, that's great. What are you seeing in today's market, Frank, on MHP in particular? And I know there's a lot going on, kind of macroeconomic, with stimulus funds and funny money out there everywhere. It's what's it doing to cost? Materials are up through the roof. I'm real worried about the dollar being devalued more and more by the day. What are you seeing from an interest rate? And what are some of your projections? And we can kind of go back and forth on some of these things, but just interested in your opinion because you do touch so many different asset classes and so many different portions of the country.
It's a great question. It seems like there's more capital chasing deals than there's actually deals in the marketplace right now. With a heavy focus, lenders or investors are really chasing multifamily and industrial. It seems like that's where there's a heavy focus. So we've continued to see cap rates compress even through the pandemic. Values continue to go up. To your point with lumber costs and other material costs up, that's obviously making it more challenging to do new developments, which is also, I think, contributing to some of the increases in value and some of the existing properties that are out there. And mobile home parks they've benefited from that as well. It seems like there's more investors today than there were 5 and 10 years ago that were looking at those property types. So there's just a lot of capital out there chasing deals right now.
No, I think you're definitely right that there's more people in the marketplace for mobile home parks than 10 years ago, 5 years ago, 3 weeks ago. I mean, it's just every day I hear new people jumping in. Where do you think cap rates are going to go for multifamily and for mobile home parks? I mean, seemingly they're continuing to go down. Is there a floor? I mean, obviously I've always thought there should be a spread of the cap rate should be at least 200 basis points, ideally 300 basis points or more higher than the interest rates. And it seems like the compression is in all these asset classes is rates are pretty flat. They went up for a minute, kind of stay up, down a little bit, but cap rates are going lower and lower. So it's like the spread of it's just I get the supply and demand of people chasing deals, but I'm just curious what your opinion is are we going to see are 4 caps going to be the norm? Are they going to go to 3? I know some portfolios, some coastal markets may already be there. I mean, Kansas City, they're not there. Where do you think if they go 1, 2, 5 years from now?
Yeah, it's a great question. They've already, you look just in the last 24 months, how much they've compressed. There's just so much money chasing these deals. On the coast, we've already seen cap rates sub 4. They're in the 3s already. And now that money continues to come to the Midwest and just keeps driving values up and cap rates down for more. It seems like there should be some type of spread. But if people are worried about, inflation, or maybe they have other motives for why they're trying to get into a property, maybe it's a 1031 exchange, it's tax avoidance, there could be different reasons. But at least with the flow of capital right now, and where you see where cap rates are on the coast, I think we still have a little bit of room here in our markets here in the Midwest. I think you can still see them go down a little bit more.
Yeah, I think so too. I think Midwest in general, they're getting lower and lower, but there is still some spread. I mean, do you attribute, touching on inflation, do you attribute, and then also when COVID hit, there's a sense of security in housing. People are going to undoubtedly need housing, and they may not need another restaurant, another sporting goods store, things like that. How much do you attribute this, decrease in cap rates to wealth preservation? I mean, if you're doing if you're paying a cap rate of 3%, and your interest rate is 3%, there's not a lot of cash flow. So are you just preserving the value of the dollar rather than have it sitting in cash equivalents? And how much of it is that versus how much of it do you think is people that are bullish on these asset classes for NOI growth?
I think it's more the former myself. I think it's a hard asset. People are concerned, is the stock market, is it overvalued? If you're sitting on cash, that's not earning you anything. I mean, there's a lot of factors, but I think people still like to have a hard asset. People need a place to live. That's not going to change. Population is still growing. So, it feels like a safer bet. You could hold it, you could ride it out longer term. If, we're going to have volatility, you're going to have ups and downs in the market, but I think a lot of people view it as just a safer place to park their money long term.
Got it. No, I would agree. Let's talk about kind of the different offerings for agency, conduit, life insurance lenders. Can you give us kind of the reader version of what the general differences are, what the terms are? I mean, I know you speak this language all the time. You know what Freddie SBL means. The rest of us may not know what all that stuff means and how we qualify for that, and then pros and cons. Because I hear a lot of people say, "I want to do agency debt." It's like, yeah, you can't. I mean, I've got a park in Iowa. I'd love to get agency debt on it, but it's only 20 pads, so minimum's 50, right? And then there's minimums of certain dollar value. We referenced $1 million, but if you could maybe just give us a quick summary of the distinctions between those, so we can better have them in our quiver for if and when we're going to use them.
Sure. I'd probably break it up by buckets. One being agency, which, Fannie Mae and Freddie Mac, which everyone's aware of, and they're probably doing the bulk of these. The second bucket would be life companies. These are the State Farms, the Nationwides of the world, down to some small life insurance companies people probably have never heard of. Third bucket, I'd probably go with CMBS, commercial mortgage-backed securities. These are the ones that are pooled together, packaged and sold off in tranches in Wall Street. People, again, if you've been in the market, you're probably somewhat familiar with those as well. Also active in the mobile home park space. And then finally, the fourth bucket is kind of a mix of banks, debt funds, credit unions, kind of a mixture of different capital sources that are out there. They're all slightly different. High level, Fannie Mae and Freddie Mac are typically going to be your highest leverage. Fannie Mae, for example, a little bit more aggressive in the mobile home park space. They can go down to a minimum loan amount of $1 million. On an acquisition, they can go up to 80% of your purchase price, assuming there's enough debt service coverage in place, typically a minimum of like a 1.25 debt service coverage. Rates today, it's a really hard question to answer. There's so many things that get factored in: leverage, loan size, debt service coverage. I'd have to give you a pretty wide range. I'd probably say, mid threes to low fours, maybe even up to the mid fours. Pricing has been a little bit wider with the agencies today, but Fannie Mae is really probably doing a more of a bulk of the manufactured housing today. Freddie Mac also is in that space. They're not as competitive in the smaller loan sizes. They have what's called their Freddie SBL, which stands for Small Balance Loan Program, which is very active on the multifamily side, probably the most active. And the small balance is defined as loans of 7.5 million or less. Very active on the multifamily side, but Freddie SBL actually will not finance mobile home parks right now. Surprising. I think at some point in the future that'll change. So if you go Freddie, you have to go through their conventional program. So it's probably more like a minimum of $5 million. So Fannie Mae really eats up the bulk of those smaller, anything below, 1 million to 5 million on the mobile home park side. The next bucket I would move over to life companies. Typically the leverage isn't going to be as high. They'll want to be more, probably 65, maybe 70% max leverage. They can be more flexible in their terms. They can also be more aggressive in their rates. I'd tell you today, a small $2 or $3 million loan, call it 65% of purchase. Life companies could be, in the low threes, low to mid threes on their rate. So more aggressive on the rate, but lower leverage. So that's kind of the big trade-off you probably have between an agency execution and a life company execution. CMBS, third bucket, I'd probably put somewhere in the middle. Leverage, not quite as high as agency, but it will be higher than life company. And rates, I'd say right now today, probably a little bit more aggressive on these smaller deals, or comparable to what we're seeing with agency. They'll also do maybe some more challenging parks, and we can get to that, like what lenders look for, but they might do some things that maybe won't qualify for an agency execution. So, and then finally, banks, credit unions, those other types of buckets of money, debt funds, more of a recourse type of lender. I'm going to look a little bit more at the strength of the borrower, a little bit different than the first two that are more permanent products.
Oh, thanks. Thank you. Appreciate that. I want to touch on that last time you just mentioned on strength of the borrower recourse. I know I see people they'll call me sometimes, hey, I want to do non-recourse because I don't have any credit. And they've been told no for a car. They've been told no for a house. They've been told no for a local bank. But you and I know it's non-recourse doesn't mean everybody can get approved. What are the borrower requirements from a criminal background or lack thereof, a general net worth, general liquidity, or general experience standpoint that's necessary to check that box to be eligible to sign on a non-recourse loan with one of these providers?
Yeah, no, good question. It varies slightly with each lender. I would say, generally speaking, lenders are looking for a combined net worth. So say you have 2 or 3 individuals that are coming together to buy a property. They'll look at a combined net worth. They'd like to see at least equal to or greater than the loan amount. And they like to see liquidity, combined liquidity. Typically, again, general rule of thumb, maybe 12 months of debt service combined between the owners.
Okay, that's good. So, I mean, as you get bigger and bigger on loans, it's just, do they continue to reevaluate that? If your net worth's $1 million the first time, you can get $1 million, but you want to do a $5 million loan the next time, you got a $5 million net worth? Or is it one of those, because at some point you got to 10, you got to 20, it seems like it becomes harder to keep pace with the acquisitions, I would think.
Right. No, good question. That's probably, I should have clarified, that's probably more on small balance loans. As they get larger, say somebody's doing a $25 million loan, maybe it's a portfolio, they're probably going to back off the requirement for the net worth, but there will still be a pretty good focus on liquidity for sure. Yeah. So you're right. Because if you're starting to get some larger loans, that could be tough to qualify.
Okay, good. That makes sense. I just went through one of these Fannie Mae refinances, and the timing of it took longer than I would have liked. And as such, the interest rate in the marketplace went up, somewhat considerably relative to my, quoted interest rate when I began the process. And I was not able to lock in the rate until all of the underwriting was done. And basically, we locked the rate in 3 days before closing in a 90-day process. So for the first 87 days, I was subject to interest rate risk. What was interesting to me was the lender, quote, felt bad about that, and they reduced their spread or their yield, which makes me wonder, why don't they just do that all the time? Obviously there's profit in there for the lender, and they didn't charge any fees or points, or it was their profit is in the spread. Can you explain to us how that pricing works and how you go about evaluating that for your clients? If you got 5 companies that want to make the loan, if I got a nice loan at 123 Main Street for $5 million, presumably you can take it to a number of options, and the differences you just mentioned, like LTV, interest rate, those are factors. But in the same bucket, there are numerous people you could take a loan to through Fannie's originators, or or how can you explain to us that process, how you evaluate that, and how those spreads work?
Yeah, I mean, the Fannie, a loan originated with Fannie Mae underwriters ultimately sold off into the secondary market. It's really, I mean, Fannie Mae and Freddie Mac are basically the 2 largest securitized lenders um, in the market. So that it's a fluid market. It's changing. Those spreads, those investor spreads, there's multiple components to kind of make up that spread. And Fannie and Freddie typically price as a spread over a benchmark. For example, the most common being a 10-year loan term. So they price as a spread over the 10-year US Treasury. So you have a couple of moving parts there. Obviously, the Treasury yield, plus within the spread, there's some components there that are, again, changing on a daily basis with the market. Where you can see some differences, if we are, for example, able to underwrite to a higher debt service coverage, that will improve your spread. If we are underwriting to a lower LTV, that will also improve your spread. So that's where you might see some variations, maybe from one lender to the next, depending on how aggressive somebody might be able to get with their underwriting. It's kind of a fine line. We have to be aggressive, but also have to be able to deliver and what we tell our borrower we can bring to the table. So that's why you might see some variations, slight variations from one lender to the next.
No, that makes some sense. I mean, I know I was given the options. If you want to go 55 LTV, here's your rate. 65, here's your rate. 75, here's your rate. And then in mobile home parks, there's these additional tenant protections, tenant lease provisions that came out relatively recently. And then if you put those in your lease addendums, you got like 6 months post closing to do it. Well, then, or you get default, in theory, then you get a lower rate. So those are, that makes sense.
That's it. It's a big discount. I mean, you can get up to 40, 45 basis point discount if you're willing to do that. So it makes a lot of sense, especially if you think you're going to hold it long term. That's for sure.
Yeah, it really does. And then I looked, there's like 8 or 9 provisions, and really they were, I think, all but one of them I already had in my lease. One of them, that's not a big deal. It's like, okay, it's basically like, don't be a jerk landlord, and proper notice before you increase rent. Don't offer people a month-to-month lease where you can jack the rent up every 2 months or something like that. And things of that sort. But no, that's interesting. I'm glad you're able to help us kind of unravel some of these terms. The other term that I hope you can enlighten us on a little bit is yield, is either a combination of yield maintenance or essentially prepayment penalties, yield maintenance, and or defeasance. Because I feel like these are complex concepts. Everybody kind of knows what a prepayment penalty is, but how they calculate them and how painful it's going to be, depending on the time of your loan. I feel like borrowers, you probably see it all the time, that borrowers don't recognize how painful it is. I'm in the middle of a lawsuit with the client now, where my client's buying the park, and the seller finds out at closing, when he's got to pay off his existing CMBS loan, that there's a $300,000 prepayment penalty. And he's like, well, I'm not going to close them. It's like, you have to close. You're at the closing table. And he said no. So we're suing him for specific performance to make sure he gets his butt to the closing table. But had he known about this big penalty that was in his loan docs that nobody seemingly reads, he probably would not have signed the contract. He would have waited out the loan, or he would have done something else. And I've got several stories like that people are like, whoa, you mean what? So maybe give us a brief breakdown, and then maybe a hypothetical. If I just got my new loan today, and tomorrow I'm going to sell the park to Frank, what does that look like from an assumption of the loan? What does it look like from a payoff, and or am I stuck until my loan terms out at year 10?
Yeah, no, good questions. I would say most loans in the permanent market, Fannie Mae, Freddie Mac, life companies, CMBS, are assumable. So if it is a situation where you think you're going to hold it long term, something's changed, plans have changed, all of a sudden you're 2 years into a 10-year loan, yet you're staring at a pretty big prepayment penalty. A loan assumption is probably, in that scenario, the best way to go. You'd probably want to advise the buyer on the front end that you're not selling it free and clear, that they're going to have to assume the existing debt. Yield maintenance, it's somewhat challenging to describe because there's some variables involved. The two main variables: how much loan term remains on the existing loan, and then what is the corresponding treasury. So what I mean by that, let's say you did an original 10-year loan term. Let's say you're in year 5 now, somebody makes an offer and you just can't pass up. So you have 5 years left on your loan term. The lender will compare the two main variables. They're going to say, well, your interest rate, let's just say, was 5%. They're going to say, well, now, since you have 5 years left on your loan term, what is the 5-year treasury yield? Essentially, if they get paid off early and they want to turn around and immediately invest in treasuries to try to maintain the yield they were expecting, they would invest in a 5-year treasury. So say the 5-year treasury is at a 3% yield. Well, there's a 2% gap. There's a 2-point gap between the rate they were collecting and now where they can reinvest. Very kind of summary is it's a net present value calculation where they maintain that yield and it covers that 2% gap. So the two biggest variables, what is the corresponding treasury of compared to your remaining loan term, and then how much loan term is outstanding.
That's a great explanation for a complex concept. And I've seen those formulas in the exhibits, these loan docs, and it's a mess. But so to take it even further, if in my 10-year loan, I was on year 9 and 6 months, I only had 6 months left, and my original interest rate was 5%, and the current 5-year treasury is 4.9%, it's not going to be that painful because I've only got a little bit of time left to maintain and only a little bit of spread. Would that be an?
That's correct. I would also add most yield maintenance calculations, they have a minimum of a 1%. So there will never be a situation where the short-term rate might actually be above your rates where you're going to pay off your loan and the lender's going to write you a check. So there's always a greater of yield maintenance or 1%. I bring that up because that question does come up sometimes. Somebody thinks they might actually be able to collect money with an early payoff. I know that did happen in some situations in the past with swaps that some banks were doing. They didn't have a minimum in there, and people were actually maybe collecting funds when they paid off a loan. But no, you will have the greater of yield maintenance or 1%. Most lenders, the last 90 to 120 days, it's open at par. And really with an agency loan, you get to that last 6-month window, you'd probably go to a 1% prepayment penalty as well. So at that point, yeah, if you were going by the letter of the law, the yield maintenance calculation, it would be minimal. So you'd be hitting that 1% minimum at that point in time.
Got it. How high would the percentage be, just if you know roughly from looking at one, if it was that example you used, a 2% spread instead of a year 5, if I did it in year 2 and I had 8 years left? Are we talking, is that equivalent to like a 5% penalty, or how high does that go?
If you have 8 years left, I mean, I've seen calculations if there's a lot of loan term left, and depending on the gap in the actual rate versus the corresponding treasury, I've seen 10, 15, 20+% penalties. Yeah. So that's why that right there is exactly why these loans have a loan assumption clause. Right. Because nobody would ever pay a 20% prepayment penalty. But obviously a buyer could step in and assume that loan and kind of move forward with it. Yeah.
And the downside for the buyer though is they're kind of stuck with your interest rate and stuck with your leverage. So if I bought it for $5 million and I'm selling to Frank for $8 million, I got a $4 million loan to assume Frank's only going to get a $4 million loan on an $8 million purchase, which means low LTV, unless you get a supplemental or a second. How would you go about it in that situation?
Fannie Mae has a supplemental program. That's right. It's basically secondary financing they'll put behind their first. It says they can take it back up to the original LTV. Now there are, so depending on how much loan term is remaining, there's some stress tests and whatnot that a lot of times you might not get all the way back up to that remaining LTV. They also have a refinance test that they have to run. So I always caution people when they start looking at supplementals. Sometimes it sounds a little bit better than it actually is once you get into the numbers. But yes, that is a way to bridge the gap a little bit in those situations. But yeah, if you have a property and you're selling it, and a buyer has to assume the loan, that could limit the buyer pool a little bit, because you're right, somebody might have to bring some more equity to the table in that situation.
Right. That's what I've looked at it as a concern, is the buyers have to bring more equity. It limits your buyer pool. Typically somebody's already in the Fannie Freddie pipeline or approvable. It limits your exit strategy. So if you're planning on selling, you may want to reconsider the long-term nature of that, and do something else. But
that's one of the questions we always ask our clients when we talk to them up front. Like, what is your goal with this property? What are you ultimately trying to do with it? Is this something you're going to keep in the family and pass down to your kids? Is this something you think you might sell in 2 or 3 years? We would never want to put a borrower into a long-term loan if they think they're going to do something with the asset in 2 or 3 years. So it's our job to maybe ask those questions and really understand what they're trying to do with the property. And then we kind of go out and try to, with all of our capital sources, find what fits best with what they're ultimately trying to accomplish.
That's good. That's definitely good to know, and good that you guys do that. Tell me, we finished our hypothetical here on this. I got my 10-year term. What happens at year 10? What does that process look like? I haven't got through one that's gone to. I haven't had the same loan hit year 10 yet. I think I know what happens. It's just like with the balloon and all that. But But I'm curious on how you explain it as far as what happens when year 10 comes, as far as, you know, essentially a refinance or a change in terms, or then when I sell, you know, what's that look like?
Yeah, good question. So yeah, at the end of that loan maturity, you either need to refinance or sell or pay off the loan, however that might be. I guess it could be with cash or other proceeds you might have available. So we'll typically advise our clients, you know, you can get started 6, 9, 12 months in advance. We'll start sizing deals, start tracking it for them, start helping to monitor, help make sure that the numbers are kind of tracking and trending and are going to show in the best light when we take it back out to refinance it. Most loans have that 90 to 120-day window at the end where there's no penalty. So we can kind of time it up to where obviously you're paying it off in that window.
Right.
But again, it doesn't hurt to get started a little bit sooner rather than later on that, just so you're not bumping up against the clock.
Makes sense. What other tips can you give us, Frank, for MHP borrowers, or any other general strategy you can give us to get approved and to maximize our value and maximize our investments?
Yeah, no, it's a good question. I think lenders who will lend against mobile home parks, some other property types, are looking for good quality properties. They're looking for properties that are well located. They're looking for properties with strong, stable occupancy history, strong, stable cash flow, good collections history. There's been a huge focus on rent collections here. With COVID, everyone was concerned with all the job losses, what's going to happen. Our tenants not going to be able to pay their rent. So having, you know, really strong collections, not having much bad debt. These are things that are looked at all property types, but obviously multifamily and mobile home parks. These are the type of things that lenders really look for. Quality of park. Fannie Mae will typically tell you they want to see a 3-star park or above. Now, that star rating system, you know, some people will tell you it's not a great system. I would say more specifically, things they're typically looking for: paved roads and curbs, skirting, designated parking, paved parking. Those are some of the things. Typically more double wides versus single wides. From a utility perspective, you know, public utilities are favored. It doesn't mean though, if you have private utilities, it can't be financed. It doesn't mean if you have a higher percentage of single wides versus double wides that it can't be financed. We're just going to have to do a little bit more digging, kind of explain, hey, this is the market in this particular location. But again, high level, these are some of the general things most lenders will look for. Another one's park owned homes. For example, Fannie Mae, I think with their charter, they can go up to 35% of the owns can be park owned, but they will not give you any credit for the rent that is generated from those homes. So they will only focus on the pad rent. So we will have to carve out any income and expenses that might be associated with park owned homes. But again, at the end of the day, like most property types, lenders are looking for good properties, well located, good, strong, stable cash flows.
No, makes sense. I'm with you that the star system's a little broken. I don't even came to find all the star systems, and I do this for a living. I'm just like, here's what it's got: this, and
Yep.
I just did a refinance on a Fannie deal that I would have called it a 2-star. It's got 3 double wides and 50 single wides, and they're all 1970s, and it's not that sexy, but
yeah.
The roads are nice, the homes are taken care of, and you know, it's a nice clean park, but it's definitely not, I wouldn't call it 3 or 4 or 5-star, but it's, you know, income's good, collections are good, good infrastructure, and
yeah,
those seem to carry the day more than it's not on a picture of a magazine. There's no common areas. My lawn mowing bill is 0. To give you an idea, there's 0 common areas. There's one playground that has mulch under it, and that's it. So it's like, hey, this is easy. So
yeah. Well, and just because something's not a 3-star doesn't mean it's not financeable. I mean, if you have an older park, doesn't have the star rating, if it has a good, strong, stable occupancy history and a cash flow that we can look to, that it might not qualify for Fannie Mae or Freddie Mac, but CMBS might look at it. One of our other lenders might look at it as well. So there's other options out there. If you have a good, stable history, I think that's more important.
No, I think I agree. And collection, I know collections are a big deal right now, industry wide, and I know that agencies are definitely looking at it too. Every month, they're in the process. What's this? You know, and they're pretty detailed on that, which they should be. But it's been more challenging in general with collections right now. But this is great stuff, Frank. Anything else before we part? Otherwise, maybe tell us where can people find you to get started on a loan?
Yeah, I mean, obviously there's a lot of details you can get into and get into the weeds. I don't want to get into too much of that here on this call, but happy to discuss. If somebody's kicking the tires on something, we're always happy to spec the time, get involved early. We're happy to put out a soft quote. It might help you sharpen your pencil when you're maybe making an offer, give you a better chance to potentially win that bid. So happy to do it. Again, I mentioned I'm with Grand Bridge Real Estate Capital. You could reach me. I'm just going to go ahead and give you my office number. I think that's the fastest and easiest way to reach me. 913-748-4453. Feel free, give me a call. Happy to walk through, give you more details or look at any deals and help you out any way I can.
All right. Sounds good, Frank. I appreciate it.
Ferd is great. Good talking to you.
All right. See you soon. Bye now.
Thanks. Bye.